we've been able to design our structure the way we would want it if we were on the other side of the table. Downside is the critical question in our business. We don't make money the way you do in an equity business on our winners. We make money by avoiding losers. We have entered the age of specialization, and we think being a specialist gives us a new leg up, a new source of competitive advantage.
Hello, everyone, and thank you for joining us for this month's edition of CAZ Third Thursday Themes. I'm pleased to be joined this month by David Golub, president of Golub Capital, one of the world's most successful private credit firms. So, David, thank you very much for joining us, and great to see you.
Great to see you, Matt, and great that my last name doesn't start with TH.
Isn't that the truth? Well, if you would, where I'd love to start is, could you just give us an overview on Golub as a firm, your investment strategy, and how you're thinking about things in the current environment?
Sure. So Golub Capital is a specialist in a niche within credit. Our primary business is lending to companies that are controlled by private equity firms. Generally, they're middle market in size, so they're making between, $10 or $20 million of EBITDA at the low end, up to a couple of $100 million. They're mostly U.S., although we do a lot of work in Europe, and that's a growing part of our business. The core of our niche is what's called sponsor lending. Sponsor is another word for a private equity firm, and it's a niche within the world of lending that used to be dominated many years ago by banks, but through a series of regulatory changes, the banks have been pushed out of the business and replaced, and we're one of the largest players that have come in as a non-bank to take their place.
Well, you've heard us say on numerous occasions we like to start with the downside discussion first. So, when you think about the current environment today for private credit and for Golub specifically, tell me, how does Golub think about downside, and how do you quantify that just sort of as a strategy holistically?
Sure. So I love the idea of having a discussion with an investor where downside is the first thing we talk about, because that's how we think. When we're looking at a new loan, the first questions we ask are, is this a good business? Is this in a good industry? Do we have faith and confidence in the sponsor that we're backing here? And maybe most importantly, if we're wrong on one or more of those questions, will there be a strategic buyer that wants to buy this company at a price high enough so we're not going to lose money? So when you think about downside is the critical question in our business. We don't make money the way you do in an equity business on our winners. We make money by avoiding losers. So it's good that we're investing in the senior secured, very top part of the capital structure. That reduces some risk. It's good that we invest on a floating rate basis. Almost all our loans are a base rate called SOFR plus a spread, so we're not taking interest rate risk. But the crux of where we lose money is when we make a loan that can't get paid back, and it happens rarely. We've been doing this for more than 20 years. We have a annual default rate of less than 1%, about 0.9%. And that's even though we're making loans to smaller companies than you typically see in a big index like the high yield index or the broadly syndicated loan index. So we're making loans to smaller companies, but we're able to achieve a rate of defaults that's about half of the broadly syndicated loan index. And that's, I think, a testament to the relationships that we have, the incumbencies, the expertise, the reputation that we've built over 20 years.
Well, before we transition over to the thematic side and the positives, in a similar vein to the downside protection, what's the biggest headwind, for your business specifically and for private credit as a whole right now?
So, ask a credit guy for one headwind, he'll give you four. We're kind of naturally pessimists, so there are always headwinds in our business. I'll rattle off a few that are on my mind today. The first is that, in the period since COVID, really, we haven't, no, I take that back, not since COVID. In the period since 22, when interest rates started going up, we've seen a very muted M&A environment. And mergers and acquisitions are an important feeder of opportunities for our business. So during a period of muted M&A, there are less opportunities for us to identify new loans that we want to make. Second headwind in our business right now is tight credit spreads. This isn't just true for our business. If you look at investment grade, securitization liabilities, asset-backed finance, virtually every element of the credit universe is looking right now at narrower spreads than probably everybody who's an investor in credit would like. Third headwind for us is falling base rates. So SOFR's been higher for longer. That's been good for us for the last couple of years. But we just had the Fed decide to cut by 25 basis points. The market's expecting further cuts. Because we're a floating rate investor, that is a headwind for us. And the last headwind I'd point out is, we're in a period of unusually high credit stress. Now that's both a good thing and a bad thing. It may not be intuitively obvious when I say that. It's obvious how it's a bad thing. In a period of higher credit stress, we're going to have more credit difficulties in our portfolio, and we're going to have a higher level of realized and unrealized losses. That's all true. But the good side of it is you need to have periods of credit stress to chase the tourists out of our market and to reestablish the attractive spreads that come after periods of credit stress. So, we've got headwinds right now. It's not anything I would describe as particularly unusual. And, I would say it's not a reason, we'll get into this when we talk about the theme, it's not a reason not to invest. I think most investors in our funds and in our asset class think of what we do as an all-weather strategy. It's someplace to be, not during periods when you think the market is just right. It's a place to park a significant amount of capital that serves as a kind of ballast, good, safe, healthy component of your portfolio that you can sleep at night with.
Totally agree with that, and maybe that's a decent segue into the positive side. So when we just think about high-level tailwinds, what's the other side of the coin there as we dismiss the negatives and think about the positive side?
Look, I think of the investing business as consisting of two kinds of businesses. They're curators and they're manufacturers. Curators are hedge funds or equity mutual funds. You got a group of people managing them who are saying, buy that, don't buy that. I'm going to sell that now. There's relative value here. I don't mean to disparage that model. I think there's a place for curating, and I think there are firms that are good at it, but it's really hard. It's really hard because you have to be smarter than everybody else in your marketplace every day who's trying to do the same thing. The second kind of investing business I call manufacturing businesses. I call them manufacturing businesses because they make the thing that they're investing in. We are a manufacturing business. We manufacture loans. Like any manufacturing business, investing businesses that manufacture rely on competitive advantages to be able to produce consistent premium returns. Any manufacturing business has to have competitive advantages or it just commoditizes. So what I like about our business is that we have a powerful set of competitive advantages that are hard to replicate, that are hard to compete with, that have enabled us to produce this multi-decade track record of persistent premium returns. And it's interesting, in many investing businesses, as you get larger, it gets harder for the manager to sustain those high returns because they're curating their 121st good ideas, not as good as their 21st. In a manufacturing business, it can be the case, and I think this is true for us, where size has actually been our friend. Size has enabled us to gain scale. Size has enabled us to specialize. And this is a good segue because I want to talk about our theme, which is specialization.
No, absolutely. So when you think about what you're most excited about, and maybe that's this theme, what are you most excited about in this environment, and where is the firm focused from a strategy perspective?
So we have a view. The view is that there's a a maturation curve, a normal, natural maturation curve in any investing business. In the early days, there's not enough capital, there are only a few firms, there are unusually high returns. And then capitalism being what it is, it attracts more money for those firms that are there, it attracts more people to create competitors, and you go through a period where the business, the industry scales up, but it also gets meaningfully more competitive and returns actually compress somewhat. And after a while, you hit a third phase. I call this the maturation phase. And the maturation phase is marked by some consolidation in the number of players. And those players have to segment. They have to make themselves differentiated. Again, going to use the same phrase, through competitive advantage. So what I'm excited about, Matt, is I think private equity has reached this maturation phase, and they now, successful private equity firms are not just financial engineers, they're not just three guys and, hey, we had a successful deal, we're now hanging our shingle out and going to collect 2 and 20 and $1 billion. Like, the successful private equity firms are really good at what they do. They have a lot of resources around each of the phases of their business. They're really good at finding attractive new businesses. They're really good at adding value to those businesses, often with a different group of people, often operating executives. They're good at improving the purchasing. They're good at improving pricing. They're good at cost control. And they're often specialized by industry and by geography. So this gets to what's happening to our industry. Our industry in private credit and sponsor finance, it lags the private equity industry and follows the private equity industry. So our industry in sponsor finance is now going through this same maturation phase. And only a few firms are able to respond to what the private equity firms are looking for. The private equity firms are looking for a fellow specialist. They want to pick up the phone and be able to talk to somebody who's as expert as they are at U.S. software enterprise resource planning companies. They want to be able to talk about the veterinary space and the opportunities to do roll-up acquisitions in the veterinary space. They want to be able to talk to you maybe in the same conversation about a deal that they're doing in London in the same industry. So what we've been able to do in recent years, firm's now 1,100 people, we manage $85 billion in capital, we've been able to design our structure the way we would want it if we were on the other side of the table, the way we would want it if we were the capital markets partner of one of these leading private equity firms. We know how they think. I used to be in private equity. A lot of our people have moved from private equity into private credit. We understand this business super well. So we have entered the age of specialization, and we think being a specialist gives us a new leg up, a new source of competitive advantage as we go into this new period. And it's interesting. We've been in a bit of a doldrum period for private equity where returns have been lower and where new deal activity has been lower. We think that's going to come to an end quite soon. And when that comes to an end, the private equity firms, the leading ones, already have ample capital to be able to ramp up their deal activity. We think it's going to be a really interesting opportunity for our investors.
As an extension of that, I'd love to throw a little off-the-wall question at you, just because I hear it a lot and I can't think of anybody better to ask than you. One of the things I hear is, private credit has gotten too big, et cetera, leading towards some sort of, prediction for private credit's downfall. How do you think about that, and how would you respond to that sort of general market observation?
So, like you, I get that question all the time. And I think it's a good question for a couple of reasons. One is I think investors are smart when they see more capital going to a space. They're smart to ask themselves, is this too much capital? And they're also smart to ask themselves a second question, who's going to win? Because inevitably, during either the ramp-up period I was alluding to or the maturation period I was alluding to, there are winners and there are losers. So let's talk about both of those. Is there too much money? My honest answer, in some segments, yes. So the place where most of the capital has come in private credit in recent years has been in financing large companies. Before 2019, it was very rare to find a private credit loan in excess of $500 million in size. All of those deals used to be financed in the broadly syndicated bank loan market and in the high yield market. In the past 6 years, there's developed now a $500 or $600 billion market that is private credit that's done in these very large size loans. I think that's become a crowded trade. I think there's a lot of capital there, and maybe it'll get better when there's more deal activity, but today it's a crowded trade. I like our market much better. We play in that larger market from time to time, but our core focus is middle market. And we purposefully have set up our business so that we can finance companies that range in size from $10 or $20 million all the way up to these large companies. And if you look at a dot chart of our transactions, I mean, it is very scattered. It's all over the page. We've done in a typical year, we've done lots of transactions all along that spectrum. So I think that's a better business model. And if you look at the core middle market, I think it's much harder to come to the conclusion that there's too much money. I think, in fact, there's still more private equity capital than there is private credit capital in that part of the market. The second piece, in answer to your question, is who's going to win and who's going to lose. Well, I don't think you have to be a rocket scientist to figure this out. We already can see the answer. There's already a very significant dispersion in performance between managers who have competitive advantages and managers who don't. If you look at the business development company, the BDC space, these companies, whether they're public or private, have to report quarterly to the SEC. They do 10Qs and 10Ks. So you can look at data going back 10 years, and you can see how wide the gap is between the good performers and the bad performers. We did some work and determined that the top quartile average was 800 basis points per year better than the bottom quartile. 800 basis points per year. That's not over the 10 years. That's per year. And if you look at the recent period, you can see, as well, just very wide dispersion where some firms, they aren't very good at sponsor finance. And correspondingly, there are a few firms, including us, that have been at this a long time, that are specialists, that have scale, that have competitive advantages, that have a track record that proves that they're good at it.
That is a stunning amount of dispersion in an asset class that I don't think is known for dispersion. I'm in shock of that statistic right there. 800 basis points is incredible. Yeah. When we put all the puzzle pieces together, and with one being the worst and 7 being the best, how would you quantify what the risk-reward opportunity is for you in private credit in the middle market today?
So I reject the question. So I said earlier that I think the right way to look at our business is to look at it as an all-weather strategy. If you are thinking about, is now a good time, I wouldn't want you in one of our funds. We have long-term investors. Almost all of our investors have been with us for a very, very long time. But I also wouldn't suggest that you come into this space. This requires work. You need to think hard about who you want to be invested in, what vehicle you want to be invested in. You want to think about tax efficiency. There are a lot of component pieces to how you want to think about investing in private credit. Those are the important questions. If you look across our funds, we do private funds every 2 years, and you look at the track record going back to 2003 when we first started doing them, you can't find a single bad fund or a single bad vintage. Like trying to market time this, wrong approach. The right approach is to think hard about what's your use case, what's the right manager, what's the right vehicle, how do I think about tax?
So in that same vein, I think there are out there numerous misconceptions about private credit, but what do you think investors are missing? What's the biggest thing investors are missing about private credit in the middle market?
Look, I think the biggest thing is the one we talked about a moment ago. I think we often get questions, well, isn't private credit today a beta play? It drives me crazy because the data is right in front of everybody. And the answer is no, it's not a beta play. There are gigantic differences between different managers. A second argument that we hear frequently comes from the newspaper headlines in Bloomberg who like to get clicks with very alarming sounding headlines. I mean, again, are there some areas of credit investing that are scary to you? Bet. Is investing first lien senior secured in good credits at 50-40% loans to value, is this worthy of those headlines? No. So we get caught up in a lot of misperceptions about other things that are going on right now. The reality, Matt, is we're boring. We actually pride ourselves on being boring. The theme of our 30th anniversary investor conference was 30 years of good boring. I mean, we take great pride in being boring, but it's a little bit challenging sometimes to get people to see that.
I love that. As we wrap up, maybe one final question. When you think about investors and advisors out there who maybe haven't invested in private credit or in alternatives or have much experience at all in the space, what would you tell them about why private credit in the middle market might be a fit for them and why it may be better than the traditional assets they currently hold?
Look, there's nothing wrong with traditional bonds and traditional equities. Right now, I think most people would agree that public equities seem high-priced, that liquid credit seems low spread. So I think in response to that, a lot of the best managers are saying, how can I broaden my clients' portfolios to include some other elements that have a better long-term risk reward? And I think as soon as you start thinking that way, that private credit becomes an interesting category. Again, if you pick the right manager and the right structure, and if you pay attention to tax, this can be a really nice contributor to a part of your portfolio that produces steady, reliable income. It's not going to give you the excitement of an investment in venture capital. If that's what you're looking for, that this is not the right place. But if you want to think about your portfolio and think about a component of your portfolio that ought to be good boring, that this is the right place to look.
David, sincere thank you for joining us for this. I think this is a super valuable conversation for the CAZ network, and I really appreciate you taking the time to do it.
My pleasure, Matt. We love CAZ and love working with you and your colleagues.
Thank you very much. We'll see you next time.